Okay, here's a video of our last barbecue. Okay. Good afternoon. All right. Nice to see everybody. We have a lot of people here. Almost standing room only, but I'll call it sitting room only. So just a few things I want to start off with. Just logistically wise, this probably will be the last time in this room. We don't have any more room for y'all. So we're thinking about going to the pavilion where it has the bigger screens, more room. We're just having to turn down. We had to turn down lots of people the last couple days that can't come. We just can't squeeze them in. The fire marshal would yell at us and we get in trouble. So we don't want anything bad to happen. So thanks for coming. Sorry to those that couldn't make it with the size, so they'll be watching it on video. So this is our, I would call it the spring financial focus seminar. So let's see here. Everybody please silence your cell phones if you have them. This dog's doing it, so make sure. So silence your cell phones. Okay, we're going to start off. I'm start off like normal. Nothing's really changed. Nathan's going to talk about what happened last year with the markets and today and currently what's happening. Daniel's going to talk about Trump 2.0 and investments and how that affects your money. Jaimee's going to talk about control what you can. A lot of things people feel out of control. Well, there's a lot of things that you can control. And she's going to talk about making your money last. Okay? And disclosure, whatever we say, make sure you talk to your accountant and so on. This is just general advice. It's not anything specific. So for your own needs, make sure that you find out if that pertains to you. And talking about disclosures, the first disclosure is, this is our office dog. This is DOGE. Some of you like him. He's a standard poodle, but he's a little short standard poodle. And he Jaimee and Daniel got him 3 years ago, and Daniel wanted to name him something cute, so he named him DOGE after the DOGE cryptocurrency coin. There's a cryptocurrency coin called DOGE. So Daniel called him that because he likes cryptocurrency. So he's been our office dog. He's our emotional support dog, okay? And but he is not named after the new DOGE, which is the DOGE government efficiency that's going on in Washington, D.C. The only thing he's efficient about is finding dog treats in your pocket. So, okay? So just a disclaimer, he's not named after the government agency. He's named after this Bitcoin or this cryptocurrency, okay? Next, okay, tax documents. We're getting lots of phone calls from y'all because you're getting your taxes done. This is from Schwab, the estimated dates. So the first production run for your 1099s, 1098s, things like that, 1099Rs if you have a retirement account. First production run came out already in January. The next one will be on Friday, so most of you should be getting most of those by Friday, and then the third production run will be in February. Many of you get these because we use a lot of exchange-traded funds, which are standard, normal type of investments that normally don't have private placements, oil and gas, and strange investments that take a long time to produce tax forms. So hopefully you'll be getting these. You can always call our office if you want. Everybody does, and we tend to get them a little sooner than you do if you go online. So just so you know, just be patient. It takes time. It's not Schwab's fault. Schwab would love to hand them out, day one, but they have to wait for all the investment companies to send them out, and then Schwab packages them up and sends them out in your 1099, 1098 forms. Okay. Going to talk about management fees because we've had some clients come to us and they've been with other advisors and they shared with us they were not happy with some of the management fees. And so it's been a while since we've looked at this, and I thought, well, let's do some research and see what our competitors are at. And so this is our management fee schedule. Starting from about 150,000, 1.5%, all the way on down the line. And we feel that those fees are very competitive. They've been set way back when we started the company, back in 1998. We have not raised them at all, so we've kept that level. So we thought we'd just share with you 3 of our competitors. We're not mentioning the names, so don't worry about that. But we thought we'd just show you 3 of them. So the first one is called Brand A. This is a company here in town that has management fees, and our fees are lower in all categories. We equal if you have if your family is less than $150,000 that we're managing. So we're more competitive than Brand A. Brand B, we're better in the mid-range, but they are cheaper if you have very small investments or over $10 million. Okay, so if you have over the 10 million, Brand B would be better or lower cost. And then Brand C, the same way. So in the middle here, where most of us are, our fees are better than most of our competitors here in town. These are fee-only fiduciary advisors that I'm comparing against. And I don't want to mention their names because it's just not cool to do that, but we just thought we'd just share with you that you are a client of ours. Our fees are very, very competitive. Okay, next thing. Daniel and I went to San Francisco to the Schwab conference in the fall, and every year there's always hot topics, and this time was cybersecurity, which has been a hot topic for the last several years, and then artificial intelligence. And artificial intelligence is taking over in every parts of our lives, and it's just amazing, and I just want to share with you folks, most of you are retired, and as we get older, it's harder and harder to identify artificial intelligence. Same with the internet. When the internet came out, there's the good, a lot of good stuff, but there's some bad stuff on the internet. Same with artificial intelligence. There's some bad stuff. And what I want to share with you is what people are doing to scam elderly people. They imitate somebody's voice. It could be your grandchild, your son, daughter, or your voice, and they try to trick you. So I just want to share with you. Here's a video I want to have you watch. This gentleman down here is speaking, and he took, who's this guy up here? Morgan Freeman. They took his face and his voice and did this.
I am not.
Whoops. Oh, no. Hang on. Nope, not what I do. Did I mess it up, Daniel? Okay, let me try it one more time.
I am not Morgan Freeman, and what you see is not real. Well, at least in contemporary terms, it is not. What if I were to tell you that I am not even a human being? Would you believe me? What is your perception of reality? Is it the ability to capture, process, and make sense of the information our senses receive? If you can see, hear, taste, or smell something, does that make it real? Or is it simply the ability to feel? I would like to welcome you to the era of synthetic reality. Now, what do you see?
That's pretty scary, and that's what's happening out there. We're getting clients that are getting phone calls that sound like your grandchildren and saying, I need you to send me $5,000 or $10,000, and they're all stressed out and they're panicking and getting you all upset. And what they've done is they've taped their voice, and then they've done something like this. This guy's just speaking. He took the words, they mapped Morgan Freeman's voice, and they've mapped his face, and they just image it like that. And so just be aware. There's a lot of stuff. We'll be sharing more and more about artificial intelligence. We are using some of that with investments and money management going on. There are good things, but be careful out there. Didn't mean to scare you, but we will be talking more about artificial intelligence in the next several years. Okay, survey and notes. So we have your survey. We'd like to get your feedback through this. If you want to hear about something, let us know. Check off the boxes. Make some notes. Take them home with you. And then also, we ask for Google reviews. If you like what we do, feel free to go on Google. If you know how to do it, if you don't, then don't bother you. But you can take a picture of that QR code there and go in and give us a Google review. And next, we have Nathan coming up. Where did Nathan go? Okay, there's Nathan. He is sleep deprived. He has a baby, and he was up at 3 this morning, so he's been ready to do this since 3. So here's Nathan.
Actually, 3 would have been wonderful. It was 2. So for the most part, he's been a good sleeper. But today, he had different plans. But anyway, so we're going to talk, like Jim said, kind of review of where things have been and just a few, touch back on last year. So stock market did pretty well. We did not get the Santa Claus rally that we hoped for. So markets were kind of down in December. I had one client say, hey, I saw I didn't do very well last year. And I'm scratching my head going, how in the world didn't you do well? So we go looking into it. No, he was only looking at his December statement. So he had no idea that he had actually had a great year. And so I say that just to remind you, when you see something that looks funky, doesn't sound right, just call us. Usually there's something like that in the background. They're like, oh, I just missed one piece. So the stock market, again, did relatively well. So here, compared to prior years, was it the greatest year ever? No. Was it the worst year ever? Absolutely not. We got really spoiled for a good chunk of time here after 2008 of getting used to positive returns. And so when we got that downturn in 2022, a lot of fear crept in. Now we've started to work past some of that fear, and we've had 2 years of optimism. Most of you have already forgotten all about 2022. Bonds have not done what most of you hoped for, and have kind of underperformed in a lot of ways. So we talked last time about why intermediate term bonds is where most of your bond exposure is at, and a lot of that has to come down to risk. But essentially, you've earned decent interest on those, but the value of them has gone down. Now, that's led to an overall positive, but not by a whole lot. The good news is most of you, we didn't have all of your bond exposure in that right away at the beginning of the year. It was kind of worked in throughout the year. So most of you probably performed a little bit better than 1.5% on your bonds. Basically what happened, there was a lot of optimism that the Federal Reserve was going to continue to lower rates at a quick pace. And then due to various factors, but a lot of it is the Trump victory, the Federal Reserve is a little more cautious. But I'm not going to go too far on that right now. So there's still pretty good options for savings. Now, you're not going to make a good chunk in the long run putting your money in these safe assets, but for something you just need safe for your next year's expenses or getting ready to buy another house or something like that, money market is still returning great. CDs are still returning relatively well. We're bummed out about this, 4.2% in the money market. We got used to the 5.2 we had at one point. But realistically, over the last decade, that's phenomenal. So currently, the economy, everyone you listen to has a different opinion. It's either completely on fire or everything is fine. When you get down to the numbers, it's not bad, it's not great. The inflation number came out today, 3%, a little bit higher than what the Federal Reserve's hoping to get, trying to be really under that 3, not at it, but still not bad. GDP growth 2.8 versus 2023 was 2.9. Over the grand scheme of things, that's reasonable. It's not great, not bad. Unemployment, 4%. That's very much within a healthy range. Now, it's on the low end of the healthy range. That's a little bit of fear of maybe inflation starting to creep back. So Jerome Powell is scratching his head trying to figure out what to do. But again, I'm going to leave more of that for later. It is quite the crazy time to be alive. I have had so many conversations this year. There have been some of the most fun conversations just in the last couple months since the election. We're now looking at so much. Jim and I were talking this morning about the news cycle is just rapid fire. And taxes are going to get lowered and tariffs are going to go up and the AI and robotics is getting crazy. There's deregulation all over the place. There's the DOGE going on, so the reduced government spending. There's wars that could escalate or de-escalate at any moment. There's ICE and mass deportations. And regardless of what you think of that, there's a lot of very wealthy people that are sucking up to Trump, for lack of a better term, right? Whether you love them, hate them, love Trump, hate Trump, there is a lot of money that is behind what he's doing. And to some of you, that seems very scary. To some of you, that seems like, well, that's fantastic. We have all these wealthy people that run so many companies ready to get behind his agenda. So I'm seeing so much of this greed and this fear and none of this in between. Now, not to say that doesn't exist. There's plenty of you that are somewhere in between, more even-tempered. But it's been really interesting to hear the differences of, oh my goodness, this is the end of the United States, to, oh my goodness, this is the end of the United States government and it's the greatest thing ever. We, looking historically, taking any bias out of it, generally when there is a new president that is of a different party than the prior president, there tends to be a bit of optimism right after they won, right? And we saw that, right after the election, markets took off. Then that new president tends to start dragging the old president under the bus and saying, hey, look at all this stuff they broke. Look how messed up everything is. And markets start to get scared. And then they, investors start looking and they go, why isn't this all fixed immediately? And they forget that, well, Congress never does anything quickly. So another thing we look at is, just in general, January can be a good indication of the sentiment for the rest of the year. Now, January was up 2.7%. That's a good month. I have a feeling we're going to see a good stormy year, right? So the forecast is storms, but they're Colorado storms, right? They are going to downpour, and the next thing you know, it's sunny and bright and beautiful. And then here comes another storm. So what we're trying to help people do is stay the course and not be the average investor, right? So over time, the average investor gets less than what they're invested in. How is that possible? It's because they're moving in and out of those investments. They're afraid and they move out because they didn't like the results of the election, or they heard this, or they heard that, and very rarely is it based on enough information to make a broad decision. Now, it's okay to make moves in and out based on your life circumstances, and there's plenty of times we do that, and we say, hey, let's take risk off the table because you need this money coming up soon, whatever may be going on in your life. So that less than 2% difference each year over a 30-year time span is almost half the amount of money at the end of it. So if you want to be the cool guy on your street and outperform your neighbors, which I think all of us at some level are a little bit competitive, and we want to beat our buddies if we're telling them about our returns, you got to pick those good investments, and you got to behave in the times you don't feel like behaving, right? And that's where we come in. Bring your concerns to us or your optimism to us, and let's have a discussion, right? I'm all on board with making things more aggressive or less aggressive, but let's have that discussion, play devil's advocate a little bit, and try to view things from a different point of view. So don't look at all these numbers. You'll go blind. What I want to point out is 2024, a lot of green, a lot of positive. A lot of sectors went well. Again, not the norm, even though we've had it the last couple of years. I want to prepare you all that we're probably going to see more of a mix of green and red this year. So the key is not going to be, oh, my brother-in-law told me that I need to be all in on U.S. growth stocks, or I need to be all in on commodities. We still need to be diversified across. Now, if you want to pick what is the absolute best investments to be in, you need to be in Congress. And especially our buddy David Rouser here got 149% last year. I don't know how he did that. I mean, the best returning asset class last year was Bitcoin, and Bitcoin didn't even do that. So we need more of those people on our team. We're trying to recruit them. So while I was up at 2 a.m., I decided to add this last slide here as I was hanging out with my new little buddy, Elliot. And he was having a great time. I wasn't. But it just reminded me of different ways that raising him and what it's taught me has related to investing, right? He doesn't obey just like the markets don't obey. I predict, the market, it should do this, and it doesn't, right? And we can't dig our heels in there, and he is the king at disobeying. So the other thing is when he is overstimulated and he is so caught up in his tiny little world, that one problem that he sees is massive, right? And I can step back and see there is so much more to this. Your little problem in the grand scheme is nothing. We do that too when we get caught up in the news all the time. We get overstimulated and drugged down into that. The other thing, FOMO, fear of missing out, will drive us insane, right? So that's where you've hired us to help make sure that you're not missing out on, are there places I should be moving money? Are there moves I should be making? We don't want you to be sitting there constantly wondering. It's fine if you enjoy it, but we don't want you worrying that you're missing out. That's why we do these seminars. That's why we have review meetings. That's why oftentimes we'll make changes before we even tell you so that you don't miss out. Last thing, I've realized I thought I'd have it figured out, and I got nothing figured out. I'm getting my butt kicked, and that's okay. In investing, we get our butt kicked. You just keep going. When 2 a.m. turned to 3 a.m., turned to 4 a.m., next thing I knew, okay, I'm not going back to bed this morning. Roll with it. we're going to get our butts kicked in the market. You can't just give up because of that. We've got to keep persevering, trying new things, and understanding what worked before and whether or not that will work again in this situation. But now I have a guy who's not a baby, but not as handsome. Daniel, come on up.
He's going to regret not calling me handsome. All right, so Jaimee and I, where's Jaimee? Where's my wonderful bride? Oh, there's Jaimee. Hi, sweetheart. Jaimee and I had just gotten married. We were right hot off the altar newlyweds. Donald Trump had just won the 2016 presidential election. Okay. Now, a couple days after the election, if you guys recall, Jaimee worked at Vanguard, big mutual fund company. She comes home from work a couple days after the election and tells me a story about how a Vanguard client was so sure and so certain that Donald Trump was like the fifth horseman of the apocalypse that he made a $1 million bet that the stock market would crash. Spoiler alert, that's not what happened. Instead of making money while the stock market crashed, the stock market did the exact opposite of what he was expecting, and he lost $1 million in one day. Lord help that man if he had to tell his wife about it. The moral of the story is that this is exactly why, when it comes to elections, we don't make speculative bets. We cut our bias out of it. We focus on our fundamentals and our philosophy, okay? We move past it. We stay invested, stay diversified, and you will be rewarded, okay? Now, you have to remember the last time I was here with y'all, I had to come into the room and talk about the one subject you're not really supposed to talk about, and I'm figuring out, okay, well, how do I talk about it without actually talking about it and cut my own things out of it? So here's the bettors, here's their track record, here's Alan Lichtman's keys to the White House. Let's just see if we can make some sense out of it. But the message was still the same. Irregardless of if the keys got it right or the bettors got it wrong or vice versa, it doesn't matter. And if anything, Eldorado Financial experienced a massive success. Okay, I asked Jim when was the last time this happened, and he couldn't tell me. He couldn't remember. Right? We don't know when was the last time this happened. Of all the clients that we manage and their assets, not one client called prior to the election or after the election, oh, it's so bad, sell out and move me to cash. That hasn't happened. For me, as an asset manager, as a financial advisor, as an investment analyst, that is a big deal. So I'll bring the keys to the White House back in 2028 just to see if Professor Lichtman can redeem himself. But regardless, this is a big deal for us. So, day after the election, what happened? Well, quite a bit. The Dow Jones Industrial Average spiked up 3%. The NASDAQ and the S&P spiked 2%. Bitcoin did me and us a lot of favors, breaking all-time highs. Oh boy. So, unlike the Vanguard client that loses $1 million in one day, Eldorado Financial assets grew by $2 million. I'll take all those days each way to Sunday. So, Trump is president, Trump 2.0. What do we get to expect? Well, for starters, a lot less of this. Nice, easygoing, volatility, some ups and some downs, and maybe some short-term volatility here and there. So a lot less of that. And a lot more jaggedness, a lot more craziness. I remember being on the trading floor at Schwab. It was during the 2018 year when Trump and China were going at it over trade war and stuff. And I remember walking into the trading floor before my shift, turning on my computer. You got TVs blasting CNBC all over the place. And I remember walking in and seeing the headline, Dow down 700 points because Donald Trump tweeted X, Y, and Z. And I remember sitting there thinking, okay, it's going to be one of those days. So Nathan mentioned about the news. This is just what it is. We're going to have a lot of crazy highs, a lot of crazy lows. Everything is awesome. Everything sucks. Just be mentally prepared for more than average volatility than what we've witnessed for the last 4 years. Now, before I move on, I want to say one thing. With great power comes great responsibility. I will also tell you, with great volatility comes great opportunity. So if you're in here sitting on a lot of cash and money markets and CDs, you might want to consider potentially taking on this opportunity, especially with all the stuff that I'm going to mention today. So 2018, we had Trump and China and trade war. I don't necessarily, tariffs are going to be part of the equation, but I don't think that's going to be the main headline story. The war that we're going to see in Trump 2.0 is going to be between the president and Chairman Jerome Powell of the Federal Reserve. Oh, by the way, do you guys like the little picture I made with AI? Isn't that so cool? Next time we're together, I should do a little presentation on AI. Wouldn't that be great? So the war that I expect to see play out this time around is going to be between Trump and Jerome Powell. So what does that war, quote unquote, look like? Well, for starters, Trump's economic policy can best be described as reflation. We talk about inflation, and every now and then you hear about disinflation or deflation. So what's reflation? I've never heard that word before. Reflation is it's basically economic policy that is used to help stimulate the economy after periods of economic uncertainty or recession. Now, that right there should start ringing some alarm bells, and I'm going to tell you why. Some typical reflationary policies you might expect: reducing taxes. We're going to briefly touch about Trump's tax cuts that's expected to expire at the end of this year. Lowering interest rates. The Fed has already done that. We'll talk about the rates here in a second. Changes in the money supply. This is what I like to call Jerome Powell's rock in a hard place. We'll talk a little bit about that. And then normally the government, they spend money and they say X number of dollars goes to this congressional district for capital projects. You can probably replace that with tariffs maybe. So we'll talk a little bit about that here in a second. So Daniel, what's the problem with reflation? Why should the alarm bells start going off in my brain? Well, the best way to describe it is a forest fire. Am I talking about California? No. I'm not talking about an actual forest fire, but I kind of am. Mankind is not impervious to nature. We're not, okay? And I get it. None of us in this room like forest fires. We don't like the smoke in the air. We don't like people being evacuated. We don't like houses burning down. We don't like this I-70 freeway being shut down. But we have to recognize that a forest fire plays a part in the grander ecological cycle. You have to burn out the old, right, to inspire new growth. The economy is basically the same thing. During COVID, when we started sending stimulus checks to everyone, we injected $7 trillion into our economy. That caused the prices of everything to go up like crazy. We saw real estate take off. We saw eggs take off. We saw groceries and energy take off. I asked Jim and Jaimee if I should throw this one in there. For those of you who can't see, it says, me knowing the top performing asset for the last 2 weeks has been the eggs in my refrigerator. Yeah, that's the business I need to be in now, apparently. But so we injected all this money during COVID. Everything got more expensive, and it started to take off. And we saw all this inflation. But really, we haven't had an economic forest fire. Okay? We have all this money in our economy, and people willing to spend that money at places like, Starbucks. People are still willing to spend $12 for a cup of coffee. We haven't had an economic forest fire to burn up all that cash to bring the prices down, because that's when Starbucks, for example, is then incentivized to bring the prices of goods and services down. So Jerome, to fight off that inflation back in 2022, if you guys remember, he jacked up the interest rates, he stopped printing money, he started selling bonds off of the balance sheet, and all of a sudden the banks got absolutely slaughtered. The 10-year Treasury had its worst performance since 1788, like back when George Washington was president. It was nuts. Now, granted, we avoided a lot of this chaos, but it was still bad. Now, this is a graph from the FDIC. Oddly enough, I find it ironic. The banks at the height of the interest rate hikes and the great inflation a few years ago was sitting on almost $700 billion in losses altogether. That's more losses than what they had back in 2008. And they're still sitting on a lot of losses right now as we speak. So Jerome jacks the interest rates, kills the bond market, trying to get inflation back under control, and then all of a sudden Silicon Valley Bank started going under. If you guys remember the banking crisis in March of 2023, okay? Now, here's the kicker. This is like the end all be all thing and like my biggest pet peeve. We're not allowed to go through a recession. If Silicon Valley Bank was allowed to crash, people lose their deposits, banks start closing left and right, people start losing their jobs, the stock market crashes, the bond market crashes, real estate crashes, the economic forest fire takes off and starts burning up all that money from COVID. Then everything starts to come back down in price stability. Homes are now more affordable. I think the median home price right now is like $420,000 at like 7% interest rates. If you took a $50,000 mortgage from like 1969 and tacked on a 79%, 80% interest rate on that mortgage payment would be the same at $3,000 than it is now. So, the big question I have to ask is that because we were able to plug the dam and keep the banks from falling with Silicon Valley Bank being the spearhead of it, are we willing to go through the pain necessary to get us back on track? I'm not chastising anyone specifically, I'm asking us as a people. So, Trump's trying to reflate the economy. He's trying to get it stimulated. He's trying to get more jobs and trying to get everything up and running, right? The problem is with doing that, you start running the risk of inflation. Nathan mentioned this morning that we had the inflation numbers come out. We're sitting at 3% right now. So on the other end of the Trump-Jerome battle that we're seeing, Jerome has this growing inflation problem that he's trying to stave off. So the thing with Jerome Powell is that since Silicon Valley Bank started going under, he can't raise rates any more than he already has because he's already going to start hurting the banks even more. The other problem is that Trump isn't going to raise any taxes. If anything, he's going to extend his tax cuts because, you know, promises made, promises kept. And then to make a bad situation even worse, we're also looking at the threat of tariff retaliation. Now, I don't have enough time to explain the mechanics of this all. If you guys have your surveys, there should be a little box that you can check that says something like, oh, let's talk about tariffs or AI or Bitcoin or whatever. So I don't have enough time to explain the mechanics of it all, but tariffs are in fact inflationary. We throw tariffs on China, they throw tariffs on us, everything gets more expensive. I got all the data and all the research papers to prove that when we had the trade war with China back in 2018, inflation did take off. Now, did it take off like what we saw after COVID? No, but still, it is inflationary. And whether tariffs are used as a negotiating tactic, you take your pick. I don't know. I don't have time for that. So we have interest rates are not going to be able to go up because that's just going to kill the banks. Trump's not going to raise taxes. We're going to have some issues with tariffs. And I think Trump is on, let me mention this. I think Trump is on borrowed time with Canada. He's on borrowed time. So Justin Trudeau is bending the knee, but Canada has an election for their prime ministership, I think in October of this year. The leading candidate is a conservative by the name of Pierre Poilievre, who is campaigning on a Canada First campaign, which includes but not limited to throwing tariff retaliation back at Trump. Now, Pierre knows that he can do this because Canada gives a lot of cheap oil and natural gas to the United States, cheap gas and cheap oil that the United States so desperately needs. Okay, so we'll keep an eye on that, but just kind of giving you guys an idea with tariff negotiations, it's not that simple. So the other inflationary issue is that $7 trillion of our almost $37 trillion national debt is going to come due this year. So we borrowed $7 trillion to inject into our economy during COVID. Now that money's due, we have to pay that back in interest. Now, here's the question I have to ask, and I've been asking this question for like 5 years now. Who's going to hold the bag? Who's going to hold this? But Daniel, I thought Elon and DOGE was going to fix all this and cut all this government spending. Well, okay, let's look at the numbers. Fiscal year 2024, government spent $6.8 trillion. It took in $4.9 trillion. We are now running at a $2 trillion deficit. We've been running a $2 trillion deficit on average for like the last 15, 20, or like 10, 15 years, give or take, okay? Elon, I think he said most recently, well, during the campaign, he said that he was going to find some $2 trillion to cut. Well, then most recently, I think last month in January, he said, well, now it's not so much 2 trillion, now it's closer to 1 trillion, but they're going to try to aim for 2 trillion. So let's just give him the benefit of doubt, and let's just say he can find 2 trillion. So he finds $2 trillion of just government waste spending, and then, you know, he cuts all that spending. So then I'm sitting here like, okay, what else? Where's the remaining $3 trillion that we need to run our government and to pay its bills? Well, we're gonna stop sending condoms to the Gaza Strip. Okay, what else? Well, we're gonna get rid of the Department of Education. All right, well, that's a $73 billion line item on the congressional budget. What else you got? Where is this money gonna come from? So let's just say that Trump and Elon wanted to pay off the national debt in 10 years. What would that look like? Bare minimum, they would have to cut by all government spending across the board by 60%. Now, take a moment and think about what that means. 2/3 of our national debt is made up of Social Security, Medicare, Medicaid. So if we cut 60% of government spending across the board, you wake up tomorrow morning, you look at your Social Security check, 60% of it's gone. 60% of your Medicare, Medicaid is gone. 60% of your national security or your military is gone. Forget about the Department of Education, Department of whatever, like left-handed puppetry if all I care. It's 60% of it has to get cut. But what's the problem? The problem is that during the campaign trail, Trump said that he wasn't going to touch Social Security. So instead of cutting by 60%, now you got to cut by 84%. But remember that the tax cuts are coming to an expire this year. More than likely, he is going to extend those tax cuts. So now you have to cut by 90%. If Trump doesn't touch Social Security, Medicare, Medicaid, national defense, and extend his taxes, we have to cut by 164%. At that point, we're invading Canada and making it the 51st state. Our GDP would increase by 10.4 million gallons of maple syrup. My biggest, look, as a financial advisor, like, spend less than what you make. It's basic. I'm going to teach my kids, spend less than what you make. You want to retire, spend less than what you make. You want to save for a motorcycle, spend less than what you make. Like, this is basic finance 101. Fundamentally, do I have any problems with DOGE? No, but don't, like, waste my time without addressing, like, two of the three largest line items on the congressional budget. That's like going to McDonald's, ordering a supersized Big Mac meal and a Diet Coke with it. Like, who the hell are you fooling? No amount of cuts, at least that I can see, is going to convince me that Elon and Trump are going to be able to cut enough to get inflation and spending back under control. They'll do some. I'm not denying that they're doing it already, but still, like, I'm looking at the big numbers and I'm like, why aren't we touching Social Security, Medicare, Medicaid? Because, I don't know, are y'all going to riot? I don't know who's brave enough to do that. So, kind of wrap it up here pretty quickly. So Jerome Powell, his term ends May 2026. That's the rock, okay? The hard place, if you remember that $7 trillion I mentioned, is that the U.S. either has to find someone to buy that $7 trillion or the Federal Reserve is going to have to print money. So either Jerome's going to term out and Trump's going to put in somebody that will do his bidding, or something else is going to break and the Fed is going to be forced to start printing money, or somehow, some way, Trump figures out who out in the world is going to be willing to buy our debt. Everyone thinks that we owe so much money to China. That's actually not true. We owe a lot. Like, Japan is the single largest shareholder of our U.S. sovereign debt outside the United States. The problem with Japan is that their yen is getting absolutely hammered right now with inflation, so they're trying to do damage control. They can't really afford to buy our bonds. China is the second largest holder. They're going through their own debt issue right now, and they have every incentive to de-dollarize their whole economy. And then England is like third place, and they're just kind of like hanging out, and there's probably so much they can buy. So I don't think there's going to be enough people outside the United States, and I don't think the domestic economy here is going to be able to, or going to want to hold the bag on this. Now, The bond market, as Nathan mentioned, the bonds have been kind of like a bane of my existence for like the last 2 years. If I can replace bonds tomorrow with something else, I totally would. So the bond market vigilantes. So what's happening? So Jerome's being the stick in the mud. He's not budging on interest rates. He's not budging on printing money. He's annoying Trump each way to Sunday. And the bond market's sitting there and saying, okay, well, if you're not going to print money and if you're not going to hold this debt, then we're going to sell off the 10-year, the 20-year, the 30-year treasury. We're going to make bond yields go up and make it more expensive for the government to refinance that $7 trillion. Even though Jerome has lowered interest rates, have all of you noticed that interest rates on the 30-year fixed mortgage has gone up? The 10-year treasury was up today, the 20-year, the 30-year, even though the Fed has lowered interest rates. This is why. The bond market vigilantes are calling the Fed out on their bluff. Now, what's going to happen first, whether Jerome's going to term out or he's going to capitulate and start printing money again, we'll have to wait and see. So that's kind of the big war between Trump and Jerome right now. So with all this inflation talk, with all this stuff that we're hearing right now in the news, what have we done with your investments? Well, very basic plays. For starters, Treasury inflation-protected securities. These are special Treasury bonds that pay you interest based on the rate of inflation. So as inflation goes up, like we saw today, the interest rates on those inflation bonds should go up with it. So we have already moved into those. The other thing that we've done is we've added broad basket commodities. Inflation's not going to go away. Until I deem necessary and I see writing on the wall that we are in a situation where we're going to see all that money get burned up, as I mentioned earlier, I don't think inflation's going to go away anytime soon. Is it going to be 9%? Probably not, but we're already sitting pretty at 3% as of this morning. So with that being said, we've already added broad basket commodities. Generally speaking, in higher inflationary environments, commodities generally do well. You're not just in gold, you're not just in silver, you're not just in copper, you're in soybeans, you're in sugar, you're in wheat, you're in corn, you're in natural gas, you're in oil, you're in ultra-low sulfur diesel. So we've already started making these plays to kind of position this as a hedge against inflation play. So I expect these to do well, but we'll have to wait and see. Now, the next time we are together, okay, before I bring Jaimee up, the next time we're together, I'm going to plan on talking about AI. So that's not going to be the big thing that is going to take a lot of time. I got a couple cool AI stories and some things to showcase to you guys. And like Jim said, it's not horrendous, but it's not all that great either. We're kind of in the middle of everything right now, and it's just kind of starting to get ramped up. So we'll talk about artificial intelligence. The big thing that we need to talk about next time is Bitcoin. Right now, Bitcoin is trading somewhere around $97,000. It was up 121% last year. My personal price target for 2025, give or take, more or less, is going to be $150,000. Okay, and kind of goes back to what we've been saying. As your dollars are being inflated, as the government, the central banks, the central planners start printing more money and the value of your currency is getting absolutely demolished by inflation, Bitcoin as a decentralized fixed asset, no one controls it, no government, no central bank, it's an asymmetric supply and demand asset. It's doing what it's designed to do. Now, what goes up must come down. I will talk about that more next time we're together. But my advice to all of you, go to youtube.com, look up Eldorado Financial, go to our video section, look up the seminar on Bitcoin I did like 3 years ago. Watch it 20 times if you have to. There are podcasts, there are books, there are all kinds of research you can do. Just at least brush up on it and try to understand what it is. We're even seeing this in Congress. 253 pro-crypto representatives were elected versus 115 anti-crypto representatives, 16 pro-crypto senators versus 12. Hopefully we will see some good legislation get passed at the federal level this year when it comes to crypto regulation. And we're also seeing a home roots growth movement going on as well. 20 states, including my home state of Arizona, has introduced legislation to take public funds to establish a strategic Bitcoin reserve. Strap on in, we're just getting started. Now, to intro Jaimee, here's a cute kid talking about money.
What do you recommend I do to stay out of debt?
Don't buy anything.
Where should I put my money so it'll grow?
In like a baggie or like a money case. In your pocket.
If I put it in my pocket, it'll grow?
Yeah.
How does it grow in your pocket?
Put some seeds in it and close it, and then put some water on it, and pay for it.
What is financial freedom?
To have freedom to you can go swimming without telling the government. Donut day.
Why is financial freedom donut day?
So it's free donut day.
So it doesn't cost any money?
Mm-hmm.
So if we just could have free donuts all the time, then we'd be good?
Yeah.
What do you feel is the most important thing to do with your money?
Save it.
Why do you want to save it?
So then you can do more stuff.
What stuff do you want to do with your money?
Buy gum and buy a new toy. Movie.
Why is budgeting so important?
Because like when your body feels mad, super mad, feel you better.
Why is it important to budget?
Because it's so important when you budge. Like if you use a knife, you'll cut it off.
Good point. Do you think I should invest my money in the stock market?
No,
Why not?
because then you won't have enough money to buy anything.
Why should I invest in the stock market?
Because it's so fun.
What is the stock market?
Grow stuff so you could plant money there.
And it grows?
Yeah, in your pocket.
Wasn't that cute? I would like to say those for my kids, but they weren't. That was a nice brain break, right? But also, I figured it was kind of a nice little tie-in to when you're getting financial advice, make sure you know where you're getting it from, right? Listen to some experts. I don't know if we qualify that, but just good to find some good experts in the area that you're seeking advice. So one thing, I don't think it got mentioned, but last time we were here, Nathan was sitting to take his certified financial planner test, this little thing here. He passed it, so give him a round of applause. And he passed it before Elliot was born, which is also super important. So this is just one of the credentials that we have here to kind of show, hey, we are experts, but also we're pursuing education because the world is evolving and changing, and so we're adding more and more education just to be the best experts we can for you, so we can give you good advice. So what Daniel, Nathan, Jim kind of talked about was a lot of macro stuff, right? What's happening in the world and the economy and all that jazz. And that's important stuff, but I'm really practical. So I like to say, okay, this is happening, right? It's important to look at. It's important to make investment adjustments. We do that. It's good to be in the know, but what things can we do here today? What can we control? So to start that, and I want to talk about our own money, right? Where does it go? So this was a really cool infographic I found on how most Americans spend their money. It's just an average. You can see about half of it goes to housing and transportation. Those are the biggest ticket items right there. And that makes sense. If you're looking at your normal budget, right, you typically have a mortgage or a car loan, and so those can really eat up a lot of your monthly budget. So if you're looking at buying a new home or getting a new car, it's really important to sit down, really think about, does this new monthly payment fit in your budget? Or if you're going to retire, Maybe you work on paying something off so you don't have this big ticket item in your monthly budget. So, speaking of our lives and what we're spending money on, to start this, we can break our life into very simple quarters, right? It's not perfect. This is just a lot of generalization. But if you think about your life in terms of quarters, right, the first part of your life is spent in education. And how do you fund your education? Usually your parents, student loans, working, things like that. That's how that area is funded. How do you fund your working life? You're working, right? You're working for money. So that's how you're funding this section. And then retirement, right? That's what we're going to talk a little bit more about, is how do you fund your retirement. So another way of looking at your assets and how they progress throughout your life is we start down here. This is assuming you don't take student loans, because if you took student loans, it'd be here and it'd go way down and then back up. But you start here and then you're in your accumulation phase. This is the green sections, the working life, right? You're accumulating, you're saving, you're putting money in your 401k just a little bit by a little bit, and you're accumulating it. And grows, it grows, it grows until we hit retirement. And most people are pretty comfortable in this accumulation stage. It's half your life where you're working and you're earning. And then you hit this retirement stage and it feels really uncomfortable. You're like, all this time I've been working and it's been steady and I've been getting a steady paycheck typically, right? Getting a steady paychecks and you've been saving. And then it's very weird to see that all the savings that you've done start to decrease. And it's not that they're decreasing for a bad reason, right? It's not that the stock market's plummeting. It's you're drawing on it, right? You're taking monthly income, and that's what it's designed for. This is what you've saved it for. But this decumulation phase can feel very, very uncomfortable, especially at the beginning, and especially if you're concerned, hey, is there going to be enough money at the end of my life? So that's what we look at a lot. Nathan and I do a lot of financial plans to say, hey, how are you going to make this work? Sometimes this is easy, you have it, it's cake, it looks really great, and sometimes we have to finagle some things. Sometimes you all have to adjust your life. So we'll talk about that. So when we're looking at how much do you need, what things do we look at? So to calculate how much you need, budget, right? That's the first one. That encompasses so many things, but when I put budget on here, it's kind of your normal spending, that first graph that I put up, your mortgage, your car, your food, your utilities, all that sort of stuff. So what on average do you spend a month? Then I add in, what are your goals, right? Do you want to buy a lake house? Do you want to travel? Do you want to go on a big trip? What goals do we need to fund? And maybe you don't. Maybe you're like, I'm happy just hanging out. But is there anything in here? Are you going to need a new car in a few years? What things do we need to factor in? Then there's medical expenses, all sorts of other stuff that can fall in here. I just threw these 3 main ticket ones. So for example, if you're looking at, assume you retire around here, right? Doesn't have to be 60. I just threw some general numbers here. But if you start at 60 and you have about all of these things together, your normally monthly spending is $33,500 a month. But we have this red area, and this is increasing. Now, why? Daniel talked about it the whole time, inflation, right? So what $3,500 will buy you today, you're over here when you hit, 75, 80, you're going to need $5,500 to buy the same amount of stuff. So that's why it's really important we're factoring this in, because especially for retirees, inflation's hard. So it's something that we think about a lot, and we make sure we factor into all of our plans. And so this is how we figure out about how much you need, right? It's not perfect, and this needs adjusting as time goes on. How do you fund it? So this is just a generalized pyramid, and there's a few main assets that you can use to fund your retirement or fund your lifestyle. So at the bottom we have the guaranteed, the Social Security pensions, the steady eddies. In the middle we have some things that are a little less liquid or a little require certain things like insurances, real estate. And then as we get towards the top, we have our retirement accounts and then other kinds of savings. In this pyramid, it's not saying that that's how you should structure. It's not saying you should have the least amount up here and the most down here. It's just kind of a nice saying, hey, these ground ones are the fixed ones, and these could be more variable. So continuing on, when we're factoring, okay, we know how much we probably need to spend, we probably need for our lifestyle. what assets do we have? So we have the fixed income, the Social Security, your pension, and these are, and some of you have pensions, some of you don't, right? As time has gone on, a lot of companies have gotten rid of pensions, so a lot of us are using Social Security, but we're taking these fixed sort of assets. The reason that these are slightly different, pension, I said, hey, some pensions don't have a cost of living, it is what it is. And then Social Security does have a cost of living adjustment. It's usually actually not in pace with inflation, it's in pace with whatever inflation they said it is. So it increases a little bit, but not a ton. So we have these two right here, but you hear that I'm on a fixed income, and so if your income is pretty fixed and your cost of everything goes up, that's a hard spot to be in, right? So this is what we look at in mindset of Social Security. We also do a lot of Social Security planning. Once you take Social Security, you can't go back, right? You've taken it, and that's it. So you can, currently, right, unless they change stuff, and who knows, there might be changes coming, there might not. But currently you could take Social Security any time between 62 and 70. So when's the right time? There's a lot of factors that go into that. This just shows a cool little break-even graph, but especially if you're a married couple, there's so many factors. So come talk to Nathan or Jim or I about when do you take your Social Security if you're wondering, because that's a big factor. And we'll help you weigh. Do you take it early and get a little less, or do you hold off and take more? But I'm not going to get into all that because that's a can of worms and you'll be here till 5. Speaking of Social Security, there's some big news recently. I forget, maybe 2 months ago or so. Maybe one. The Social Security Fairness Act was just passed. Doesn't impact all of you, but for those of you that worked for like a state, like para, and paid into that, or paid into para, or some kind of where you worked for a state pension and you didn't withdraw for Social Security, and you're part of the windfall elimination program or the GPO government pension offset, this act just said, hey, we're doing away with these. So, good news for some of you. I wish I could tell you more details. They're figuring it out. In true Congress fashion, they said, let's pass this bill, but not figure out any details. So they passed it. They're just figuring out all the details. How much retroactive is it? What is the actual amount? So stay tuned on that. But I just wanted to make sure to share this in case you hadn't seen and it impacts you. Now it makes me happy because now I don't have to tell everybody the bad news. Sometimes I'm the bearer of bad news when I say, oh, you didn't know about WEP. Sorry. Okay, so continuing on. So I talked about, hey, we have our fixed income. Then we have our fixed income, Social Security, your pension, but then we have investments to make up for the rest. The investments can be a little bit more on the variable side, right? That's why I put this little money sign, because the opportunities can fluctuate, and it depends on your situation. How much risk do you want to take? How much reward, et cetera, et cetera. So to calculate, we take all of our assets, or all of our funding, so our Social Security, our pension, investments, but do those equal what we need each month for the rest of our life? In this situation, okay, so I did some math. And I added all these up. I said, okay, these are about 861,000. This equates to 946,000. Shortfall of 885,000. Our goal is to have you not in that situation. And if we run a plan and this is the case, there's options. But before I show you the options, I'm going to show you another way to look at it. That's kind of I'm a visual person. I like to see visuals. So this is actually a little graph from our older planning software, but I love how it looks. It's just nice and easy to read. So in this situation, right over here at age 60, this couple needed $6,000 a month. And this green part is their fixed income. It says direct income, but this is their Social Security and pensions right here. So got a little bit here. This right here is when the other spouse takes Social Security. So notice the greens here, pretty steady. Like I said, it's fixed. And then the yellow right here, this yellow area, it says capital income. That's just their retirement accounts. It's the investment area. It's the amount that can kind of make up. So notice right here, they have a little fixed income, and then you pair it with drawing from your investments. That's best case scenario usually. You have the magic. You have a little fixed, a little bit of variable, nice to pull from. And notice this is increasing every year. It's that inflation. So what $6,000 buys you here, you're going to need a little bit more here. So that's why this is increasing. And then this red part is where, we might run out of money. So they're good until age, 92, and then they're still going to have money. They're still having Social Security and pension flow in, but everything else has ran out. So there's some options. What do you do if you're in the spot of, there's red. Some of these are basic, and we can sit and talk through every situation uniquely, especially if you have questions, but, basic, right? You can save more, maybe. Right? If you're in the working stages, yes, you can save more. If you're in retirement, maybe you don't need to spend as much as you have coming in and you can stash a little bit. Maybe. You could lower the retirement lifestyle. So that could just mean, hey, let's lower the monthly budget, monthly spending that you're doing. Maybe instead of taking 2 trips a year, you take 1, stuff like that. Obviously, you could work longer, or you could go back to work and do a little part-time gig, potentially. Like I said, they're just different options, not always right, not everything's right for everyone. The one that we have control of and can help you with is maybe you need to increase your rate of return. Maybe you need your investments to grow a little bit more. Maybe. I'm not saying that's right for everyone, I'm just saying it's an option, it's something that we can help you control. And we can help you control some of these through helping you budget or whatever. But there's options. So when you look at something and you see red and you're like, oh gosh, I'm gonna run out. It's not the end of your story. There's plan B and C and D, and maybe you sell your house and downsize. There's so many options that we're here to help talk through with you. So there's another tool that we have as I kind of pretty close towards the end. We have some other tools. We talked through your fixed versus your investments. These are all your investments, and there's things we can control with your investments. You typically have different kinds of buckets. Not everybody does, but there's 3 basic buckets. There's your pre-tax, like your 401k, your Roth, which is your after-tax funds, and then your taxable, so your regular brokerage, your banks, your CDs, that sort of stuff. And we can help you strategize. Which buckets do you pull from when? Because there's taxable implications, and by pulling from the right buckets at the right times can actually extend the amount of money that you have if you're pulling from it right. So one just quick example, I'm not going to share every single example because there's thousands, but one really quick one could be, hey, okay, your required minimum distribution age, aka age 73, and say you're giving money to your church or a charity you like from your blue bucket, from your bank account. You get your Social Security, you pay your money to your church. What we could do is say, hey, don't pull it from here, pull it from your red bucket, pull it from your IRA, send it directly to your church. You don't owe extra tax on it. Maximizes the income, and actually then you have more money left in your blue bucket. So that's just a very simple, just an option, and there's so many other ways we can mix and match this. But this is stuff that we do every day. When you call and say, hey, I need money, we're looking at this sort of stuff to say, hey, where do we pull from? Sometimes that's why we ask, okay, what's your income? If we haven't talked about it recently, is because we're trying to help you maximize your money. So this one is just a very, very general, like, how do we decide which one to pull from? And it's general. It's not for everyone. It's not for every situation. But usually you start taking your required distributions because you're required to. You don't want to pay penalties. And then going on down, you kind of leave, you take out of the taxable, and then you keep a lot of times people like to keep their Roths towards the end because it's tax-free. And pretty rare that you get to have income tax-free, right? So this is just a general flow, not always what we follow. There's exceptions to every rule, but there's that. So I'll leave you today. I feel like I leave with this stuff a lot. We talked about a lot of stuff we don't control, right? We don't control inflation or DOGE or any of that stuff that's happening. We don't even control the stock market. But we control the investments we put in our stock market. We control what we spend on. And if you're focusing on this and your response to that, you're going to have so much more outcome positive outcomes coming by responding to what you do control rather than responding to, oh gosh, I can't control what's happening in DC or whatnot. So just keep that in mind when you watch the news and you're like, oh my gosh, this is scary. Or whether you watch the news and you're like, this is amazing. Calm down and focus on what you control. So I'll leave you with, hey, we have our survey on the table. As Daniel said, I added something to the survey that says, hey, what topics are you interested in? And I added different topics. So you can check boxes. You can add things. I left some lines if I missed some things that you would really like to hear about. But we just want to make sure we're talking about stuff that you guys think is interesting, hopefully at a venue that can hold more of us next time. And side note, I just want to say thank you for RSVPing, everyone, because this made it a lot easier. Anyway, thank you so much for coming today. We appreciate you all. Fill out your surveys. If you have any questions, throw them on there. And I'm done.